Welcome back. Futures indicating a big rally at the start of trading this morning as earnings season continues. Dow Industrials right now up 243. Look at the NASDAQ up another 1.25% this morning, 159 points higher. Disney reported first quarter earnings last night. It beat on both earnings and revenue. But the company's first report since the CEO, Bob Iger, returned to the company also included a big job cuts announcement. Disney will cut 7,000 jobs. It's trying to cut $5.5 billion in costs in an effort to reorganize the entertainment, ESPN, and parks and experience divisions. The stock is rallying this morning. It's up 6.5% right now. We're looking ahead to more earnings this morning. Lyft, Expedia, PayPal reporting after the bell tonight as well. Joining me right now is Oxbow Advisors Managing Partner Ted Oakley. Ted, it's good to see you. Thanks very much for being here. You know, interesting to see all these layoffs, and yet we had that big jobs report, which was much better than expected last week. And then you look at corporate America, and even though the recession worries have sort of pulled back a bit, there's some serious layoffs underway.
Yeah, Maria, there are. I think people don't notice it and they don't add it all up. But in the end, you know, it's a slow thing, but it happens. We think that'll continue through the next couple of quarters. So
what's behind it? Do you expect a real weakening of the macro story? What is your expectation for the macro story in 23?
Well, at Oxbow, you know, Maria, we're thinking that the next few quarters you're going to have lower earnings and lower margins. And I don't think that's in the market yet at all. I don't see that being in the marketplace. So we're looking for weakness in the overall S&P earnings, and we're looking for margins to really contract quite a bit in here.
Yeah, it's interesting that you say that because we're hearing from Fed governors again. New York Fed President John Williams, Federal Reserve Governor Lisa Cook, both said more rate hikes are necessary to bring inflation down, after Jay Powell himself said that the disinflationary process has begun, but it's going to be bumpy. Philadelphia Fed President Harker and Fed Governor Christopher Waller set to speak tomorrow, and we're looking ahead to some inflation data next week. The CPI is out on Tuesday. Nancy, jump in here, because you've got the Fed pretty clearly saying more rate hikes are coming. Yeah. And yet, look at this market year to date. We've got growth leading the way.
Yeah, I think the market has led the Fed all the way through this cycle. You know, they took almost a year to raise rates, but the market started discounting the rate hikes. So I do think that in a way, the market is not listening to the Fed any longer, because there's just been such a credibility gap. But I'm curious what you think, Ted, in terms of how much they're going to hike. What is the where are we on inflation? I'd like the sticky inflation number came out, and it's still very high, the Atlanta Fed sticky. And I'm just wondering what you think about that, how quickly inflation will come down.
Well, I think it's going to be this year. It will stay, at least in the 3 to 5 range. And I think it's going to be hard for them to get it to 2. That, to us, you have to have a fairly tough economy, tough on the economy for us to get back to 2%. So we're looking for it to stay, reasonably high, which would keep them up most of the year. And I don't think people have factored that in either, if you want to know. I think everybody's overly optimistic in that respect.
Yeah, and Lou, don't forget that we also have the Federal Reserve's unwind of the balance sheet. And that's something that Thomas Honig has brought up so many times on this program, that when you take $1 trillion of liquidity out of the market, you've got to expect disruption in the stock market.
Absolutely. There's much work to be done, much bumpiness ahead. And Ted, I wanted to ask you, you were talking about unemployment and layoffs. You're seeing the tech sector kind of right size after expanding massively during the pandemic. But tech employment's only about 2% of the overall economy. What concerns me is leisure and hospitality and Disney. That's 11% of the overall economy, and now we're starting to see cutbacks. Are there specific sectors you think are more vulnerable to layoffs, to margin compression, or on the flip side, ones that are more attractive and that you're allocating to?
For us, we're allocating to obviously different things. I mean, if you look at, we own companies like, MasterCard, Visa, the gold miners, things that we think will have plenty of cash flow this year. So they're a little bit different mode than some of the others. But the problem about tech, I think, was that they had it so good for so long that they were sort of living too high above where they should be. And so that's not abnormal. What we're seeing now, though, is you're starting to see these ancillary businesses that feed into real estate, a bit in manufacturing. If you look at the PMIs, see they're starting to lay off and at least cut back on the hours.
Ted, it's great to see you. Thanks so much for weighing in on all of that.